Okay, I think we're ready to start almost. Thanks everyone for joining me today on a Saturday. Today I'm going to talk about the recent survey we sent out about the upgrades and improvements to Investtobefree.com and the 3 Stocks to Wealth newsletter. Mostly to the 3 Stocks to Wealth newsletter, I'm going to talk about the performance of the newsletter since inception, including 2015, the rest of 2015 and 2016. I'm going to talk about stop loss strategies that we can add to the methodology and which ones seem to work best. And I'll also talk about other improvements to the newsletter, things that you remarked on in the newsletter. We had a few hundred people fill out the survey, and there was a few of you that wanted to have a webinar. So I decided to go ahead and hold this today. Didn't really advertise it too much. And it's 2 p.m. on a Saturday, so we only have about 18 people so far in the webinar room. But I am recording this too, so for those folks that have to leave early or something, I can send out a copy of this, and you can watch it at your leisure. So, okay, yeah, as I was saying, the survey results that we got back were very enlightening. And I'm going to talk about that. But first, I want to start off by talking about Investtobefree.com and the 3 Stocks to Wealth newsletter and explain what it is for those folks who are unfamiliar with it. And if you can, before I do that though, too, I was going to see if this microphone is working correctly. It's showing up as working here on my side. If everyone can text me, there's a little chat box, I think, in your lower left-hand corner. If you can type in yes or okay, and I'm already getting some yeses, and so we know this is working great. So great, you can hear me. If you have questions throughout the webinar or comments, just go ahead and type them in, and I'll get to them toward the end. And I definitely want to get your input on some of these different ideas of changes and upgrades to the Investtobefree approach. Okay. So first of all, I want to start off by explaining what it is again for those folks that are new to it. And basically, it's an approach that came out of a lot of requests that I got from people on Tradetobefree.com. A lot of people who subscribed or tried out the newsletter for 3 weeks, wanted just a newsletter that told them what 3 stocks to hold for the next week. And they wanted something very simple, very straightforward. They didn't want to do any technical analysis. They didn't want to, check their stocks every day and do the checking of the news and all the work that's required with technical analysis. I mean, that's one of the benefits of buy and hold is that you don't have to do any technical analysis with the stocks. That strategy is buying and holding the stock for a long period of time. So there's not that follow-up consistent time you have to spend every day. And so I thought, well, maybe there's a way to go ahead and use technical analysis to find the best trading setups with the right fundamental characteristics where people can just hold them for 3 weeks. I had people with Tradetobefree.com newsletter that would just simply buy and hold those stocks for a week. And I thought to myself, wow, okay, well, the stock hasn't broken its short-term downtrend yet. So, you want to wait until it hits the technical entry point before you buy it. But they did that anyways, and they just bought and held it for a week. And often they did very well. And made me think maybe there's a way that I could cater to traders out there and investors who want to use technical analysis or have the benefits of technical analysis and also the benefit of being in the stocks that have the rising estimates that are beating the estimates or the top growth stocks that have the strong charts that are in bullish trends currently. Without doing all the extra work you need to do to pick those technical entry points and exit points and all that management that goes on day in and day out. So I did a lot of homework, a lot of research, and did a lot of back testing and found a strategy that can do just that. And that's where the Investtobefree.com 3 Stocks to Wealth strategy came from. And we've been out there using this for 4 years now. It was launched back in April of 2012. And, if you're just joining the webinar, if you have any questions or comments, go ahead and just post them in there in the message box, and I'll get to the questions shortly after the webinar. So I appreciate you doing that. What was I saying? So yeah, so that's where the 3 stocks to wealth strategy came from, for those folks who just don't have time for technical analysis each week and just don't want to spend as much time trading stocks and yet have a very good rate of return. So that's where it came from, and we've been doing this for 4 years now with the 3 stocks to wealth newsletter, picking the top 3 stocks for the coming week. And basically all you do is you get the newsletter on Thursday night. The stock's coming off the list, you sell at the market open the next morning. So in other words, you put a market order to sell at the open on Friday. And then right away you put an order to buy the stock that's coming on the list, the new stock, at 1.5% below the open price on Friday. And that's the best way to enter the new positions. And then you just hold the 3 stocks until the following Friday. The next newsletter comes out on Thursday, and I pick the top 3 stocks. I follow the market very closely. I spend a lot of hours during the week following the market, finding trading setups, reviewing company fundamentals. I look at thousands of charts to find these best stocks each and every week for you, and that's what the 3 stocks to wealth approach is all about. So, and with this approach, I want to mention that there's no risky options, there's no margin, there's no shorting or leverage of any kind. And I'm going to show you some returns that are pretty phenomenal. But keep in mind that this approach requires no options, requires no margin, no shorting. It's a long-only system. There's no leverage that's used with this. Yet, even during a bear market for small caps like we had last year, we had a very good rate of return. So, it's a pretty amazing strategy. And, I use this strategy in my own accounts. One of my larger accounts I have dedicated to this approach, and it works very well. So, okay, so this is kind of a review of what I've just talked about a few minutes ago. This Investtobefree approach, it basically cuts through the clutter of information online as well. I mean, there's so much information out there on all these different stocks and strategies. Some get very complicated, and you got to dig through all that, sift through all that, find the strategy you want to try, test it for a while, and then start using it. And oftentimes when you use it, you have to follow up with it each and every day. And a lot of folks just don't have time for that. If you have a family like I do, if you work, if you have a day job, and want to spend time with family and do other things, it's tough to find the time to use many of those other approaches. Okay, and so this kind of cuts through all the clutter. It gets the entire market down to the top 3 stocks each week, picked by a successful, experienced trader, and one that's been doing this for a long time and does it in their own accounts. So it just takes that very complicated, time-consuming process and cuts it down to just 15 minutes per week. And for most folks, that's what they really need to be successful in the market. Because for a lot of folks, spending a half an hour, 2 hours a day trading sometimes is just not going to fit into their schedule. And so that's why this is so powerful. Okay, so the other reason why we want to use this strategy, if you don't have time to trade, or if you have a full-time job, you can use the Tradetobefree strategy. And if you have a half an hour per day, I would say, to follow up on your positions, to look for new entry points, new stocks that are reaching their entry point, and stocks that are exhibiting sell signals. If you don't have that kind of time, but yet you're looking for a higher rate of return on the aggressive portion of your overall portfolio, this can achieve that. And one thing I want you to keep in mind is that 40% per year on average will achieve a 5-bagger in 5 years with compounding. So basically what I'm saying there is that when you compound a higher rate of return, it grows a lot quicker than you would think. You can look this up by looking up a compounding calculator online. But 40% per year consistently for a 5-year period with compounding. In other words, you earn interest on the interest you made the previous year. That turns that initial investment and multiplies it by 5. Actually more than that, in just 5 years. Okay, so that's the power of taking a small portion of your overall portfolio and putting it into a very proven, aggressive approach. Makes a world of difference in your returns over time. And I've got some more slides I'm going to show you here in a minute to illustrate that. So, if you look at typical investing, what most experts will tell you is that, right now the S&P 500 is probably a little overvalued, which is probably the case. And that the returns over the next 4 or 5 years, you can expect less. Last year we saw a 1% return, about 1% return for the S&P 500. The year before wasn't, or actually this year is proving to be very lackluster too. I think we have about 1%, not even 1% for the S&P 500 so far as of today or yesterday at the close. Okay, so we could easily see a 4%, 3% rate of return for the S&P 500 over the next 5 years. Okay, and like I said, most experts will tell you that, over the next several years, you have bonds, you have treasuries, you have stocks, you have some gold, and so forth. You can come up with a diversified portfolio that really makes sense for you, by talking to your financial advisor or doing your research yourself. And, most experts will tell you don't expect more than 4, maybe 5% a year. And so if you have $100,000 and you get that 4% a year, that would turn into, over a 10-year period, that would turn into $162,000 compounded. Okay, now let's say you take 30% of that money, whatever is appropriate for your own financial situation, which you can talk to a financial advisor about and have them look over your personal financial situation. But if you put, say, 30% into an approach that, makes 40% per year, if you get that rate of return on just a small portion of your overall portfolio, that turns that 30% or $30,000 over 10 years into $1.53 million. Okay, with compounding. All right, and again, you can look at a compound calculator online. I think it was Albert Einstein that said that one of the most amazing things on earth is compound interest and how that works. So if you're not familiar with it, look up some of these numbers and you'll see that, making that rate of return 40% per year with compounding yields that $1.5+ million in 10 years. So that's a nearly $1.5 million difference between, a 4%, return that most experts tell you to expect to, the $1.6 million, the much greater account size over that 10-year period. Okay, just by taking a small portion of your overall portfolio and putting it into a proven aggressive approach like this. So that's why we have this, and that's why I tell people, you don't have to put everything into this. You shouldn't. You should be diversified and put a small portion of your overall portfolio into this approach, and that's all you need. I mean, with those kind of returns over the long term, it doesn't matter what you start with. Okay, now there are the fees with using this approach. It's a very proven, very successful approach, so it does cost quite a bit. You have to pay for that performance, obviously. But if you have a decent account size of 20,000, 30,000 or so, you can, if you make that kind of return, it doesn't matter what you start with. That's my point over the long term. So that's the power of an aggressive approach that yields a higher rate of return. So I just wanted to point out why this is so important to consider for your own portfolio and to use a very good aggressive approach with stocks in a small portion of your overall portfolio. So hope that makes it clear. So, okay, so now I promised everyone the performance highlights over the past couple years and since launch in 2012. And so we did the calculations, added it all up, and found it was 294% since inception in April 2012, and that's before commissions, slippage, and fees. And for the overall, for the S&P 500, which is the 500 biggest companies by market cap, it's 51.36%, again, before fees and commissions. So in other words, $30,000 becomes nearly $120,000 versus $45,000, okay? So actually that should be 4 times the account size, so nearly 4 times the account size. So if you're starting with $100,000, that would be $400,000, and if you're starting with $500,000, that would be $2 million. So, and it just grows from there. So back in 2012, when I launched the newsletter, I said that this could be a 5 to 10 bagger in 5 years, and that's what we were going for, and we are still on track to do that. In fact, I'm going to show you in the charts in a minute, but if we just achieve a 30%, less than that actually, 25% return over the next year, that would turn that, 120, we're close to 120 now, and that would bring that pretty close to 150, which is a 5-bagger in 5 years. And I think we'll do more than that as long as the market doesn't go into a strong bear market or bear market. If we get a decent return over the next year, I think we can achieve that easily. We should. So, okay, so now I want to compare this, again, very passive approach almost to trading that requires just 15 minutes per week versus other top long-only strategies with the higher turnover. So you're in essence trading. For instance, with Zacks, that I believe they have a weekly or a monthly portfolio rebalancing in their strategy results. The IBD 50 changes all the time, so that has, I believe, weekly portfolio rebalancing. So I took some of the top strategies out there. These are the top strategies too that have worked very well over the long term too. I mean, Zacks and IBD are a couple of top long-only systems out there. I mean, their long-term performance is stellar. And you can see from this chart that, we're beating those hands down. If you look at 2015, for instance, Zacks, the number one ranked Zacks stocks, they actually underperformed the S&P 500, and that was primarily due to the bear market in small caps. Small caps went down, I think, somewhere around 8 to 10% last year, if memory serves me right, the Russell 2000 small cap index. So small caps were down last year. That's one of the big reasons why Zacks was down. And I threw in the IBD 50. I took the IBD 50 ETF that was introduced last year and sometime last year, and it was since the inception, it's down over 6%. They don't list I couldn't find a listing of the current Zacks performance. Actions Alert Plus, that's Jim Cramer's newsletter. He had 2.34% in 2015, but that was only up till June of 2015. I think at that point last year we were actually up about 40%, 50%. So, and then we had the correction later in 2015. But you can see that this strategy, this newsletter, is just beating all the other strategies out there, hands down. I've yet to find a newsletter that can outperform this. So it's a really good strategy. Now here's some more comparisons too, and this is getting to one of the things that we're going to address with this next release of the 3 Stocks to Wealth newsletter. One is the drawdown. Now, with any strategy, whether you have a mutual fund, an index fund, bonds, or whatever your strategy is, if you buy bonds and just hold them to maturity, that's different, obviously. But if you have a bond fund, you'll have drawdown. If you have a mutual fund, you'll have drawdown. Drawdown is basically just the difference between the high point in the performance chart and the next successive or the lowest point in the performance chart that comes after that high point. Okay, so it's drawing down from the peak of the account value. Okay, and I can show that to you here in the chart here in a minute. But the max drawdown last year was 30.2%. And this is based on the end of week prices. We always sell and buy on Friday mornings, so we take the Friday morning open price and use that for these calculations. And you can see that if you compare the 3 Stocks to Wealth newsletter to the Russell 2000, and we do have a lot of small caps in the newsletter, that Russell 2000 drew down 25.6%, again, based on the Friday open price each week, okay? So intraday, if you look at the max drawdown based on intraday prices, that's a lot more difficult to calculate with this 3-stock portfolio. It's really tough to do because you have to look at it minute by minute. So I just took the end of week and compared it to the end of week Russell 2000 drawdown. But that gives you a good idea, the difference. It's not really much more than the overall market for at least a small cap index, okay? And I believe the S&P 500 was probably in the neighborhood of 13 to 15%. I think the max drawdown for the S&P 500 was around 17 or 18% during that correction late last year. Okay, so this gets into, though, the top reason why in their survey why people were reluctant to use this or another aggressive approach for a portion of their overall portfolio to increase their wealth over time, and it's volatility. And the most important thing you can do with any strategy like this that's proven over time is to be consistent with it. You have to use it week in and week out. You can set out times where the volatility is really high, but if you start doing that, you almost inevitably miss out on the really good weeks, really strong weeks where the volatility drops all of a sudden and the market takes off. So, it's really tough to, completely eliminate volatility. I mean, you really can't do it. But what you can do is you can introduce certain strategies to reduce the volatility. And I'm going to show you the results of some of that here later in this presentation. But in the survey, I wanted to point out that, many of you like the stop loss strategy over the other types of volatility risk reducing strategies. Okay, some people like to buy puts. Put options are just option contracts where the option value goes up if the price of the stock goes down. Okay, in most cases, I don't believe that's a good strategy. I think for a large account and for hedge funds, I'm sure it works pretty well, because if they stop loss 1 million shares and dump that on the market at once, it's gonna drop the price quite a bit and also upset a lot of people probably in the process, because you're going to see a big washout in the stock, and then the stock will come back, will bounce shortly after that in most cases. So for them, if you're a hedge fund manager, if you have that much stock in the market, what you're probably going to do is buy puts, or maybe sell a part of your position and buy puts at the same time. There's different strategies you can use, but for smaller accounts and for retail traders and retail investors such as us, a stop loss strategy actually works probably the best of all the strategies. Okay. Selling calls was also a good strategy. A lot of you said you would sell calls to reduce risk, and that was number 2 answer in our survey. And that's actually a very good strategy as well, and something that we may add into this 3 stocks to wealth strategy, and possibly another strategy that we may have coming out here soon dedicated to smaller accounts. It's interesting to note that buying inverse ETFs came in last. And I think one of the reasons that is because ETFs and inverse ETFs especially tend to underperform the market that they're trying to track, or the index they're trying to track. So in other words, if you have an inverse S&P 500 index, an inverse index, if the S&P 500 goes down 5%, that inverse index should go up 5%. That's the sort of the initial belief, but when you look at the numbers, you find that if the market goes down 5%, that inverse ETF may not go up 5%. It may, over a year, it may go down. So it's tough. It's tough to use an inverse ETF over a long period of time, because the market would have to go down a lot in order to have gains in that inverse ETF over that long period of time. So it's more of a trading vehicle, and it may have implications, and it may help us with this strategy as well. So we're looking at that now and running some tests and some back testing, and see how well the Investtobefree approach 3 stocks to wealth newsletter works with the inverse ETF option. So to reduce volatility. So, all right. So here's the latest performance chart. And what I've done here is I put the 2 lines, the red line and the blue line. Now the red line is for using a buy limit order approach to buy new positions. Now this is the approach that we have advocated, since 2012. So initially we said 1.5% below the Thursday close. The newsletter comes out on Thursday evening. So we said buy at 1.5% below the Thursday close. It was easier to do the calculations based on the open price on Friday. And when you sell the stock coming off the list on Friday and go to buy the stock coming on the list on Friday, you'll see that open price. So you can use the prior day's close. You can use the open price on Friday. The results over the time frame that we've tested were about the same. In fact, I think the closing price on Thursday may have been a little better. But it's very, very similar. So we use the 1.5% buy limit order approach based on the Friday open price. And it's been used for the performance charts for the past few years. And then we also have the market order approach to buy new positions. And that's just saying that, okay, we sell the old stock coming off the list. Now we have that money to buy the new stock coming on the list. Let's just throw a market order in there and assume we get the market open price on Friday. Okay, and sometimes you get a little bit above, a little bit below. But with the 1.5% buy limit order approach, you're guaranteed to get that price or you won't get filled. Okay. Now, if the order doesn't fill, what we say to do, and in our videos and also in the performance results on the site that we've had there for a few years, that we've been updating for a few years as well, what we say is if that limit order doesn't fill, if you don't get that price, you go in just before the market close and you just change that buy limit order into a market order. Okay. And in our experience, what we've seen is that if you go in at 330 or 345, oftentimes the stock is trending higher into the close. Sometimes it's trending lower. If it's trending higher, you often get, if you change that limit order that wasn't filled to a market order at 345, let's say, or 350, you often get a better price than the closing price. Sometimes it's worse, sometimes it's better, but it's kind of a wash in between the two. So that's a pretty, you can get that price, that closing price on average over time. It's really, really close. And in many cases, it's better. Now, as far as getting the price when some people say, one person came to me and said, I'm not getting the market open price on Friday when I sell the stock coming off the newsletter. And I compared, they were using a broker I'd never heard of. And I looked at the numbers and I looked at our own account and I saw that with Fidelity, we're getting the open price almost every week. Like almost every week we get the open price on Friday. Okay. And occasionally we'll get like a penny or two less. Sometimes we'll get a better price. Recently we got a better price for one of the stocks. So, but in almost all cases we get the open price on Friday. So this 1.5% buy limit order approach to buy new positions is really good. And you may be a good day trader and you may understand day trading patterns and opening range breakouts and volume weighted average price and all the concepts that you need to understand to be a good day trader and have done it for a long time. And you may be able to beat these prices that you get, with this approach of just buying 1.5% below the open price. But it's tough. Yesterday we worked at it and I think we got 1/10 of 1% better than what we would have gotten with the 1.5% buy limit order approach to buy new positions. So, but we, worked at it and we applied a lot of knowledge and skills that we've developed over the years to do that. And it was tough. So that's why I say it's kind of a no-brainer to use that approach to buy new positions, because that 1.25% to 1.5% below the open price is very, very, very good at beating the market order approach of getting the open price on Friday. And so anyway, and that removes slippage for all intents and purposes. That pretty much reduces slippage on the way in, and slippage on the way out has been negligible with Fidelity. Okay, now Scottrade I think uses the same order processor as Fidelity, so I think Scottrade would have the same results. And other brokers maybe better, maybe worse, I don't know. But that's one of the things that I'm going to start doing in the next upgrade is go ahead and review with people, their the market price they got when they sold and the price they got when they bought, and compare that to the actual open price for the stock listed on the in the data feeds, the actual open price, and see where there's any problems. And it might be the broker, it might be late, entering the market order after the market opens, which is not recommended. So on. So, but okay, getting back to this chart though, I wanted to show you the chart before the strategy, this new strategy that we're working on to reduce volatility. Because as you can see here, that this was about as much as a small cap Russell 2000. This drawdown here was a little bit more, but that drawdown is what I think a lot of people don't want to ride through. Sometimes they don't want to ride through these drawdowns, and the problem is that you have to ride those drawdowns. If you're in a mutual fund, if you're in an index fund, if you're buying the S&P 500 index. You can see here, this is a drawdown of 15%, 13%. You have these drawdowns in the stock market, no matter what strategy you use. So you gotta be able to withstand those, and but there are also ways to reduce the volatility too. And what we did was we worked on an approach that looks at the option premium in the market. Okay, now we're not going to listen to talking heads on CNBC. We're not going to talk to all the experts and what they're projecting and what they're saying, because you get a lot of different opinions, and some are smart and some are not. Some are not so smart. But when you look at volatility, the VIX, for instance, which is a measure of option premium, okay, you're looking at, not what people are saying, but what people are doing. If people are buying a lot of put options, if big money managers are buying put options, that option volatility goes up, or that volatility index goes up, the option premium goes up, okay? And we've got a lot of volatility in the market, right? So we use a strategy based on the volatility in the overall market, and that began to spike last year in mid-August. Okay, we went bearish in our newsletter on Tradetobefree.com in early August, and you can see that by logging in and seeing the newsletters back in the early part of the month. But we stuck with the Invest Be Free approach, and then after the volatility hit, we said, you may want to be on the sidelines in cash, or going with half positions for a while until things quiet down. And but when we went back and started testing different stop loss strategies to reduce the volatility, we found that a strategy based on the VIX, whereby you sort of stay on the sidelines in cash when the VIX is in a certain trend and is a certain level, okay, and or a certain level, you go in the sidelines in cash and stay in cash until that VIX gets to a level or in the right trend, okay, to support moves higher in the stock market in general, and the stocks in this newsletter. So now when we applied the strategy, we found that the results were much better. Okay, we've got another $10,000, $12,000, another probably this year, or from the point where the market became volatile back in August, another 10%, 5-10% anyways, in the returns. So not only did it reduce volatility, now the drawdown is like 10 or 11%, which is probably less than the S&P 500. But you also have better performance too. So that's a huge benefit. And I think one of the things that turn people off to aggressive systems sometimes, riding that volatility, those ups and downs, which are a bit magnified with any system that you use, like this, where you're in and out of stocks, and buying and holding. If you just buy and hold growth stocks, you're going to have volatility much worse than this. But if you can pick those places where the volatility is exploding and say, during those weeks, let's just sit tight in cash and wait for the volatility to subside. Okay, now you got to get back in when you see that volatility index start coming down and hit a certain point. You got to get back in, or you're going to miss out on some of the big gains. Okay, so that's the challenge. Reducing volatility and keeping most, if not all, the gains. In this back tested approach, we're showing a lot less volatility and even better gains during that period. Now we applied this just from August of last year through the current time. So we're trying to play with this and find the best volatility reducing strategy while keeping most if not all, or even more of the gains that we've enjoyed over the past 4 years. So that seems to work very well. Now we can marry this volatility strategy with a stop loss strategy as well, and we're going to try to find a combination of the two. So not only are you sitting in cash when it's bad to be in the market, period. But also you've got a stop loss where when you are in the market, your losses are limited. Occasionally a stock will gap down below the stop loss point, but that's unusual. If you had on one of these weeks the market pulled back in August of last year, I think the market pulled back over 10% in a week's time. Okay, so we may go ahead and just put a stop loss strategy in there, a wide stop loss strategy to limit the losses to less than the overall market, for that week. Okay. And so that can be another way of reducing volatility, smoothing out results over time, and just having it more palatable to continue with this approach, week in and week out, which is key. You have to do that to see the big results over time. And as we all know, we need the big results in the aggressive portion of our portfolio to reach our goals over time. It's almost required for most of us. Okay. Other things I wanted to mention to you, again, this is something I talked about earlier. With this strategy, there's no options, there's no margin, there's no leverage of any kind. Okay, we have very few penny stocks in this, stocks which are stocks less than $5. That's the definition of a penny stock by a lot of experts, and we have very few of those. And those tend to be very volatile. They tend to go up for a day or two or three and then crash. Sure, if any of you out there have bought and held penny stocks, you know what I mean. There's very few penny stocks that have what it takes to make it into our newsletter. They have to have the big earnings beats. They have to have rising estimates. They have to have, and or strong growth in sales and earnings. And there's just very few penny stocks that have those kind of qualities. So 99% of them are garbage as far as investments go. Okay, so. And again, with this strategy, there's no follow-up technical analysis needed. You just buy and sell on Friday morning. After the newsletter comes out on Thursday, you basically put a market order to sell the stocks coming off the list on Thursday evening or Friday morning before the market opens. When it sells at the market open, okay, you put in a buy limit order for 1.5% below the Friday open price, and then you set an alarm on your phone. Okay, you put an alarm on your phone. You say, okay, tell me when it's 3:30 or 3:45. Okay, when that alarm goes off, you check to see if the order is filled. If it hasn't filled, you go ahead and change that buy limit order to a market order just before the close, or 15 minutes before the close, or half an hour before the close, just before the close, within a half an hour, let's say. And then you're done. You're done for the week, and now you have the top 3 stocks for the following week. Okay, and someday at some point, we may have a big event that happens that is bad for the market, but you got to realize too that there's big events and that are very good for the market. If the Fed comes out and says, "Oh, we're going to have the next round of QE, and we're going to drop interest rates." China's growing faster than we thought too, and Europe and Japan is out of doldrums, and they're improving. Okay, so you may have that type of news hit the market within a couple days. Okay, so if you're out of the market during those 2-3 days, you're going to miss out on a big rally in the market. So this strategy keeps you in the top 3 stocks each week. That's the whole goal. Okay, and you can reduce volatility by sitting in cash during certain weeks where the news is really bad for the market. Okay, But you wanna be in there when things turn around and get better, because at some point they will, no matter what happens in the future. People have been predicting Armageddon for 30 years and it still hasn't happened. So, is it going to happen this year? I guess there's a chance it could, but it hasn't happened for decades. And the bad news bears that are out there to come up with these scare tactics to try to get people to buy a newsletter, to buy gold or whatever. They've been wrong for so many years, and every year they come out with the next video that's going to claim that the world's going to end. So, if the world's going to end, it's going to end. I guess that's the point, and it hasn't happened yet. So if you want to get a good return on your investments, it's important to be in the market, and good things happen too. And when those good things happen, you want to be positioned right to make big gains. And these gains over a 4-year period are enormous relative to the S&P 500 down here. So you need a strategy that keeps at least a portion of your overall portfolio in stocks in the market, so you can capture that. Okay, so I know the other point I wanted to make was that the strategy that we have to reduce volatility, the one that we've developed so far, has very little impact during the good market conditions. Okay, where the strategy really, really kills it. This period here where there's no bear market in small caps, these times where it makes those kind of returns, the volatility reduction strategy doesn't really affect it, doesn't really apply, okay? Because the VIX and the trend of the VIX is, and the pattern of the VIX, the price pattern of the VIX is such that we would stay fully invested during those weeks, okay? And again, we're going to add a stop loss strategy to reduce the potential downside volatility even more. And we're doing some more testing with that. So probably it's going to be a wide stop loss strategy, somewhere in the neighborhood of, I'm guessing, somewhere in the neighborhood of 5 to 10% for each stock. So, if you get a week where the market goes down 11%, like we saw last August, stopping your losses at 8%. So now you've beaten the market over that last week, and then you can go into the next week or sit in cash for a while until the volatility subsides. And that's a very good strategy. And how we get to some of these improved results, yet still, are poised to make big gains in the weeks and months ahead once things quiet down. So, okay, so I want to go over the other survey responses that we got in that survey we sent to everybody a couple weeks ago, and then I'm going to go ahead and answer your questions that you have here. And it looks like we got a recording of this. It looks like it's working this time. One time we tried to record one of these webinars and it didn't record, but this time it worked, so great. Okay, so here's the other survey responses. Now, nearly everyone had time to consistently use this approach, which is 15 minutes per week. So again, with our newsletter, it's costly. We charge a lot. We deliver the performance though. And with it, it only takes 15 minutes per week. On our site, we have the videos that kind of teach you the strategy so you can begin to start using it yourself if you want to do all the work. But to be really good at it will take a lot of time and effort on your part over a long period of time, as it has with us. So, keep that in mind with the newsletter and with my expert analysis and my abilities that I've developed over the past 10 plus years trading. I've been able to perform or get the performance that you've seen in the performance charts, which is really, really good. So, if you can try to do that yourself, you can go for it, and it's going to take you a long time though to get there. So just keep that in mind. And all right, so most of you said that 15 minutes per week obviously is not much time to spend, always on Thursday and Friday. 3% of you said that you didn't have the time. Okay, that was out of 150 to 200 people that answered the survey. And 13% though preferred technical trading techniques and had the time to analyze and make decisions required. So if you like that, Tradetobefree.com, the sister site to Investtobefree.com, is where you want to go. And okay, so many people wanted a lower cost option dedicated to those who wanted to start with an account size of less than $20,000 and fewer trades and commissions. Okay, so for those folks that have or want to start with a smaller amount and see how things go, we're developing a hybrid strategy to try to achieve similar results. I mean, it's going to be definitely hard to top this, over 4 years. But we're certainly going to try. And I think with the 3 Stocks to Wealth newsletter, we will improve it over time. And I think we can meet or beat that. I mean, we're talking, 40% a year, 40% a year. And, I feel like we can make it better, But as far as a hybrid strategy that requires fewer trades per year, right now it's about 170 trades per year with the 3 Stocks to Wealth newsletter. Now when I say trade, I mean each trade. So when you sell a stock coming off the list and buy a stock coming on the list, you always hold 3 stocks. On average, half of those change every week. So every week on average, you got about three or so trades, okay? Because you got to sell. You pay a commission on the way out and pay a commission on when you sell and pay a commission when you buy the new stock. So that's going to be on average 3 trading commissions per week. And some people are saying, well, I pay $8 with Scottrade or, $1.50 with Interactive Brokers, and I've got a real small account. So those commissions really add up and take a chunk out of my performance over the entire year. So I really want to make fewer trades and that's going to make a difference for me. So that makes a lot of sense for those folks that, I'd say have less than $20,000 to put into this strategy, $15,000. So we're developing a hybrid strategy that's less costly, requires fewer commissions, which is key, and hoping for similar results to the 3 Stocks to Wealth newsletter. And we're going to try to pull that off. But that would be huge for a lot of folks out there who want to start small and then grow their account and then graduate to the 3 Stocks to Wealth newsletter over time. Okay, and another thing that people pointed out, and this is one of the things that I think will be a big improvement to the new site, is a way to review entries and exits. It seems kind of I'll say mundane or trivial thing. You should be able to put a market order in and sell at the market price at the open the next day. And, like I said, with Fidelity, we're able to do that, consistently week in and week out. Sometimes there's minor variations. Sometimes we get a better price. But by reviewing your prices versus what the actual market open price is on a chart, on a spreadsheet, can help you pinpoint any problems with your online broker, or if you're not putting your market order in, if you're putting it in after the market open, which you shouldn't be doing. If you're after the market open, you should be using the buy limit order strategy, where you try to buy below the market open price, because that outperforms the market open price strategy. That outperforms that over time, as you can see on the chart. Okay, and again, we're going to add a stop loss component to the strategy that I talked about earlier about reducing volatility. And you can see on the chart again that it really cuts down on the volatility here in late 2015 and early 2016, and also increased the results. So which is great. Now, we have some benefit of hindsight developing that strategy, so I wouldn't expect to make a lot more with the volatility reducing strategy, but it will reduce volatility, which will keep you in the game and keep you in the strategy week in and week out more easily for most folks. Okay, and also a lot of you guys wanted to have a coaching program or an advanced video course. 30% said you wanted to learn how to do it yourself. You wanted a coaching program, or most of you wanted video courses, video instruction to develop your own system based on this proven strategy. And that's a great idea. And we're starting to develop both of those. And if you'd rather do it all yourself, you can definitely do that. And I'd like to ask everybody, what's your preference right now? Would you like to develop your own strategy, or do you prefer a newsletter where the top stocks are selected for you each week by an expert? I'm just curious if you're still with us. Go ahead and put down in your chat box there what you would prefer, whether it's a video course to teach you how to do it all yourself, or whether you want the top 3 stocks each week. Just want me to pick those for you. So, okay, well, I'll let you think about that. In the meantime, I'm going to go over all the questions you guys have. One thing I wanted to mention too is that, based on the questions here that I'm answering and mostly on the survey results, I'm going to go ahead and make the changes, any new changes that I want to put into the new release. I'm also going to, finish up all the existing changes I've been working on over the past year to reduce volatility, and also to review entries and exits and find, and putting that in place. And also adding some more video instruction as well to make it even simpler. It's a very simple strategy, and it's something that anyone can do, whether you know technical analysis or not. If you don't know technical analysis, if you have no TA knowledge at all, it's a very good system, because all you have to do is put the order in at 1.5% below the open price on Friday when you enter a new position. And when you exit, like I said, you just put the market order to sell at the open on Friday morning, and that's it. I mean, if you want to use technical analysis to try to, beat the results over time, you can certainly try and do that. If you're not really good at technical analysis, and when I say that, I'm talking about day trading skills, not swing trading skills, but day trading skills. So if you don't understand the concepts of volume weighted average price and opening range breakouts, and Friday, how trading goes on Friday mornings versus other days of the week. If you don't know all that stuff, understand all that stuff, it's not a good idea to try and beat this. Try to beat the approach where you buy 1.5% below the market open price. So okay, so yeah, so that new release of Investtobefree with all these add-ons for reducing volatility and the other things I mentioned in this webinar, we should be coming out with that within a few weeks. Okay, so we're getting pretty close already, and I just got a few things to add based on the survey results that I've been working on. But before I leave today and say sayonara, I'm going to go ahead and go through your questions here that you have and see if I can answer those for you. Okay. All right. So Keith from the UK. Hi, Keith. It says, I would have a problem with this approach. I have a SIP account similar to an IRA. The cash released by a stock sale cannot be used to buy another stock until 3 business days later. In effect, this will only allow me to trade half my account. That is a great question, Keith. I'm glad you brought that up. In the United States, with Fidelity and all the major online brokers now, there is a way where you can just call your broker and say, I want to make my IRA limited marginable. Okay, this it's a new status they have for IRA accounts. You don't make it marginable. You can't use margin in an IRA in the United States. You can't do that. But they have a limited margin status. So in other words, when you sell a stock and you buy a new stock coming on the list, if you sell and buy the same day using proceeds that you got from the sale, okay, that's fine in the U.S. no matter what, right, in an IRA. But if you go in and try to sell that stock within 3 days, the new stock within 3 days, okay, then you have a good faith violation, all right? But if you change your IRA status to this new status, and I forgot what it's called now, I think it's limited marginability or something like that. Again, you can't use margin, but it will allow you to do that, to buy and sell as if you have the proceeds immediately, rather than waiting the 3-day settlement, which is what we also have here in the U.S. Okay, so it's a very simple thing to do. You just call your broker, you ask them for that, and then you can go ahead and you can buy and sell as if the funds are available immediately, whether you buy and sell 3 times within 3 days or not. Okay, so that solves that problem completely for you. I don't know if the UK has that same option. You might want to check with Interactive Brokers. Maybe they would do that, given that they're based in the US, and I think they do have UK customers. But check with your online broker, and they may be able to make it very simple for you to do that. I'm not sure how the UK works though, offhand. Okay, Bob asks, will you be adding inverse stocks when market might sell off? That's another option that we're looking at, and we're going to do some back testing and make sure it works. One concern is that the inverse ETFs do not match the inverse return of the indices. Okay, so we may do it on the Russell 2000, an inverse ETF on the Russell 2000. Given that most of our stocks over time have been small caps. Okay, but with the S&P 500 over some of the periods we've looked at, we saw a drop in the S&P 500, but the inverse S&P 500 was flat. And so, we'll have to look at the back testing results and make sure that, we get the upside given the potential downside if the market goes in the other direction too. So you want to be sure to check that and make sure that it does work, as well as the other options for reducing volatility, or adds to it, or adds something of value to the system. Okay, so how do you protect against any potential big losses? Asked Carl from Mesa. Yeah, that gets back to the stop loss strategy. I think a wide stop loss is the way to go. Like I said, something in the 5% to 10% area, I think would be ideal. It could be based on a nearby support area too, a little bit below that. That would probably be very good as well. You got to be careful with stop loss orders though, because with some stop loss ranges, if it's right below the current price, if it's like, I don't know if it's 3% or 3.5%, in many cases, what happens is that you get shaken out of your stocks. The stock comes down, price comes down, and very often it rebounds because the fundamentals are so strong, because it's beating estimates and the future expectations are rising, or it has strong growth. More often than not, it comes back and goes higher. So the initial work we've done shows that some smaller stop loss amounts, or percentages, I should say, like a 3% stop loss or a 5% stop loss or a 4% stop loss, or there's a certain range of stop losses that tend to reduce results quite a bit. Okay, and that's what a lot of studies have shown over time, is that stop loss orders tend to reduce your returns over time when used consistently. Now, one option is putting a wide stop loss, making it much wider than like 3 or 4%. Another option is to keep a real tight stop loss. That's another option that we're looking at. And we're doing the back testing, and with these type of stocks tend to act differently because they have the big earnings beats and because they have rising future expectations. If you talk to any analyst, they'll tell you that it tends to put a floor under a stock if the company beats by a wide margin and the estimates are rising. So, and that's what we're seeing in our back testing again and again. So, we got to be careful with that. And we'll find the best levels based on that back testing and our own knowledge and expertise. Okay, John asked, when will these changes be available to the newsletter? And like I said, probably within a few weeks, we'll have most of the changes rolled out, and we'll have new pricing structures and so forth. And we're thinking about making it a non-recurring subscription too, that provide an option for recurring subscriptions if you want to have a small discount of like 3% or something like that. You can have it recurring. If you want to just have it be a one-off where it's just for 3 months or 6 months or a year, we'll have some option where you have just a one-time payment for a fixed amount of time, and if you want to renew later on, you can. So just wanted to throw that out there too, and let you know that will probably be an option in this latest release. Okay, Greg says, did the VIX filter testing go back to 2012 in the chart? Will those move to cash recommendations be included in the weekly alert? Okay, no, we didn't go back to 2012. We went back, looked at some of the high volatility periods in 2014 and early 2015. Now, if the volatility index is below a certain level, which it is most of the time and has been most of the time, the vast majority of the time over the past few years, prior to August of last year, then it doesn't affect returns. It doesn't really apply. I mean, if the market is trending higher and the volatility is fairly low, this strategy works very, very well. It has ups and downs, has some down weeks that are usually pretty small, and some big up weeks, and some modest up weeks. It varies, of course, from week to week. You can look at the performance chart again, and you can see that, over time, it tends to go up very nicely and has pullbacks along the way, but over a month's time or 2 months' time or 3 months' time, during those kind of market conditions where the volatility is low and the market is trending higher, which is actually the majority of the time, which occurs the majority of the time in market history. So during those times, we don't need to apply the strategy to be in cash, because we want to just ride that higher. It's going to go higher, and very likely to go higher and go up a lot. So over the months. So we looked back at 2014 though, and early 2015, where we had a spike in volatility, and we saw that in the times where the stop loss add-on would have you in cash. And again, you don't have to use this add-on if you're fine with the existing newsletter, and you just ride that volatility up and down over time, and you're fine with that. Just keep doing that. But if you want less volatility and to smooth out those results over time, putting that VIX filter in there, I'll call it VIX filter now. I like that term, VIX filter. It didn't really impact results that much. It helped during weeks where you had the drawdown, but during the up weeks where the market, where the volatility was not so bad, it didn't impact the performance at all, because you'd be fully invested in the 3 stocks in those situations. Okay, but again, we can add the wide stop loss as well, and take off the table those situations where the market goes down, let's say 10% in a day, like the flash crash when the market went down 10% during a session. I think it was 10%, 9%, something like that. But a big drawdown during the day, we can take that off the table, with these wide stop loss, with a wide stop loss. And you can lose less than the overall market if the market goes down 10%, 12% in a day. Okay, so Peter asked about the option for accounts less than $20,000. Yeah, Peter, I'm thinking of a strategy that incorporates selling covered calls and holds the top lower priced growth stocks in the market. Okay, so the best stocks where you can sell covered calls, hold the stock, for a few months, have fewer trading commissions that way, make money on the covered calls as month after month, and just being these stocks that are trending higher in the long term, okay, and have completed a pullback where they've already had their earnings. The earnings that came out, it was really, really good earnings with rising future estimates. So these type of stocks with the right kind of chart and the right kind of price level, if you have a $10,000 account and you have a $100 stock, you got to buy 100 shares of the stock to sell a covered call. Okay, so this would be a strategy dedicated to finding stocks in that $10 to $50 price range where you could sell covered calls. That's one option. Another option is to just find these really top growth stocks that are beating estimates with rising future expectations, that are in the beginning of a new uptrend. Within a longer term uptrend, they've gone through a phase where there's been a downtrend over the past few weeks to a couple months back to the uptrend support or close to it, and they're starting to trend higher again. They've had great earnings, rising estimates, great chart, where you can hold that with a wide stop loss, but you can hold that for a month, 2 months, 3 months, and have much fewer trades and fewer commissions you have to pay. So I think and because it would only come out once a month or once a quarter, it would cost a lot less too. So that's what I'm thinking of, and I think that would be a really good alternative to investment newsletters, and I think will again beat nearly all the investment newsletters, all the other newsletters out there. So that's what we're thinking about, and again, that would be dedicated to those accounts, $20,000 and less primarily. Because if you have a larger account size than that you want to start with, then this is going to be probably the better approach and make you more money, as long as you follow the approach closely and have a broker that's not charging you a ton for commissions. So that's what we're thinking of, and look for that later this year. Okay, my app does not have stop loss. Is that the same as stop limit or stop market or sell limit? Okay, this is, I'm not sure if I'm pronouncing your name right, Lourdes. I'm not sure if I'm pronouncing that right. I'm sorry if I'm getting that wrong. But yeah, I'm not sure if all brokers have stop loss orders necessarily. I know that the vast majority do, the larger ones do. If you have an online broker that doesn't have a stop loss option, a stop loss order option, I would definitely shop around and find an online broker. I would look at Interactive Brokers. They have some of the best commission rates in the industry, and they often charge you just over $1 per trade. So definitely think about doing that and contact them and see if they have what you need. Okay, at last I checked, I think they required $2,500 to start an account with Interactive Brokers. So that may have gone up. It may have gone down. I'm not sure since then. So definitely check them out. And yeah, any major online broker will will have a stop loss order. Now, I think on some penny stocks, they won't allow you to put a stop loss order in because of certain market conditions. And yeah, that might be another issue with some, penny stocks and certain stocks. Now, normally with our stocks, the ones that I recall, putting a stop loss order in wasn't a problem, but we'll definitely look into that and see whether that you can put a stop loss order in when we come out with a newsletter. Once we introduce the strategy, look into that and use that in our use that in the newsletter, use that information to let you know in the newsletter the best approach to take with these. So hopefully, but it may vary from broker to broker too. I'll have to check into that because I know in some market conditions they'll tell you that they'll say you can't put a stop loss on the stock. So again, it's oftentimes it's the smaller cap penny stocks which we tend not to have in the newsletter. So. Okay, Keith just asked, I think I may have picked you up wrong. I thought that you had introduced that low volatility method. Are you still thinking about doing so? Yeah, I think, I mean, this lower volatility method I'm talking about is, moving to the sidelines in cash. Okay, so that's the first method. We know that appears to work very well in high volatility environments or environments where you can see these periods of higher volatility. That seems to work very, very well. So that's one thing we'll definitely introduce. Now, adding a stop loss strategy on top of that. So during the weeks where we say, you know what, the volatility is such that we want to be in these 3 stocks, okay, but we'll go ahead and put a stop loss order at this level just in case there's some kind of market crash, or just in case there's something that happens to that particular stock that's really significant. That would help protect you in those situations. And we haven't seen that too many of those situations. I think the biggest loss has been like 15-20% or so during a given week on a particular stock. We've had some stocks that have gone up 30%, 40% in a week. Those are the outliers. That's rare to have that kind of performance to the upside or downside in a week. It's pretty unusual. But, with that stop loss, that wide stop loss, if it's a 10% stop loss, if you have a stock that goes down 20%, you got a stop loss at 10%. If it goes through that 10% stop loss during the day, you're going to be out with about a 10% loss for that stock. It's 1 out of 3 stocks, so you're looking at 3% of the overall aggressive portfolio to the account that you have dedicated to this approach. So that's the value of the stop loss order on top of the volatility rule of being in cash during certain weeks. Okay, so again, these are add-ons. Something you can choose to use. You don't have to if you don't want to. I mean, this performance over the first 4 years is without using any of that. No stop loss orders. No volatility rules that say you need to be in cash. It's a pretty amazing run for the first 4 years. Again, if we add the volatility rule, that reduces that volatility and may or may not increase results over time. So I think that, but I think for a lot of people, that's what's holding them back, and keeping that volatility lower during those periods where the market is just pulling back sharply. I think that's a key for a lot of people to stick with it, because that's the key to success in the long term, is to stick with it week in and week out And, when you see those big drawdowns in the overall market, in your mutual fund and index funds and stocks and growth stocks, and in this approach too, you tend to lose your enthusiasm, and then you go to the sidelines in cash for a while, and then you stay there for a while, and then you miss out on these big runs, like we've seen over the past several weeks. So that's what keeps you from reaching your goals in the long term. Okay, you got to be consistent week in and week out, and if you can somehow control volatility, that keeps you enthusiastic, it keeps you in the game, and it keeps people more settled and more willing to ride out those ups and downs, or when they're a lot less. So when the down periods are a lot less. So okay, well, I think that wraps it up. We're recording this. A lot of folks couldn't make it today on Saturday afternoon, but we have a recording of this, and I'll go ahead and send that out to everybody afterwards. I want to thank everyone for joining me today. Again, the upgrade will be out here within a few weeks, so look for that in your inbox. If you see the emails dropping into your bulk email, your spam email, be sure to put that into the inbox, so make sure you see all the notices that we send out, and you'll get that as soon as we go live with this. We'll have that along with a special offer to join, and later this year, the other alternative option for smaller accounts. So, okay, well, that wraps it up. Again, thanks a lot for joining me today, and look for those announcements in the future, and best of luck in your trading and in the future. Have a great day.